And it was another down day for the S&P 500 as investors digest weak economic data this morning. Our next guest sees volatility ahead, calling August one of the weakest months of the year, especially in post-election periods. But he's not bearish. Let's bring in Carson Group Chief Market Strategist Ryan Detrick and our own Senior Markets Commentator Mike Santoli. Guys, welcome. Ryan, you're saying 4 to 6% pullback here in the S&P wouldn't be unusual, yet you're still overweight tech and some of the growth of your stuff. You like industrials, financials as well. Why do you see this as a volatile time with weak labor data, but not a reason to sell?
Yeah, John, thanks for having me back, and happy one-year anniversary. Right, a year ago today was the worst of the yen carry trade, down 3% with a 50 VIX spike. So it's a long way from there. You think about it, I've come on with you guys all summer saying expect a summer rally. Well, that's happened, right? 28% rally, we know that. And then we never say blindly invest in seasonals, but it is what it is. And with the charts I sent you, August doesn't do well post-election years. When you have a second-term president, stocks have never been higher, right? Down 6 times. So that's just something to think about. But one of the near-term worries I have, get a little technical here, but the number of stocks above their 20-day moving average has been trending lower the last couple of weeks, whereas the S&P has been going higher. That's just some internal things that are saying maybe it's time for a pause, maybe it's time for a break. The reality, though, is this is still a global bull market, not just U.S., global bull market being led by strong earnings, profit margins. We get into some of that stuff. But, just be aware, we've been pretty spoiled, and August tends to be that month. You kind of slip on a banana a little bit, and I think maybe expect some turbulence here sometime over the next several weeks.
Mike Santoli, this is a market, it feels like, that continues to largely shake off doubts and bad news. I guess that's how bull markets react?
Typically, yeah, John. Arguably something might have changed. I mean, almost in a too cute fashion on August 1st when we finally broke that pattern of being like well above our short-term moving averages, having no 1% down days. So we kind of got out of that mode. Now, the question is, does that automatically mean, you could sort of mark down the sort of sharp but benign pullback that it makes sense to expect based on what Ryan's saying? I mean, I guess where I come down on it is, it's the most plausible scenario for expectation setting purposes to just sort of not be too surprised if we do run into something here. But, as that echo of the yen carry trade last year kind of reminds us, it's not so much just that it became August. It's that something came along and the market wasn't able to shake off, and therefore stress levels go up. So I'm looking at a very, very kind of 50-50 day in terms of breadth today, not big moves in the indexes, and the volatility index notches up a little bit because it shows you we're sort of clenching for the possibility that we could hit a little bit of turbulence.
Ryan, what does bracing for turbulence look like, especially if August is known for these out-of-the-blue events like the yen carry trade unwind that we're talking about last year?
Right. We think, great question there, Morgan. We think it'd be fairly contained, like I said, between 4 to 6% pullback. That could be right about the 50-day moving average on the S&P 500 and right about the February peak. So we don't expect something major. Remember, on average, you see about 3 to 4, 5% mild pullbacks a year. So that could be one thing. Now, one thing, just let's have some good news here. When you're higher in May, June, and July, like we just were, so that's that sell in May. Everyone tells you how bad it's supposed to be, but higher those first 3 months. The rest of the year has been higher 15 out of 17 times with a median return of more than 8%. So I'm just saying, just maybe we chop around, maybe frustrate a little bit, but we are still overweight equities. We have been, honestly, for 2.5 years now, and we still think that's the way to go. But just brace for some volatility is how we're trying to tell our Carson advisors right here.